Here's another example of bond conversion. It's question 34 on the practice review. Here we have 400,000 6% bonds outstanding, and there's 20,000 of unamortized discount as of July 1, the last time we updated the interest and also paid the cash out to our investors. The bonds are convertible at a rate of 20 shares of $5 par value common stock for each $1,000 bond, and 300,000 of the $400,000 of bonds are being presented for conversion. So the first thing we have to do is figure out how many shares of stock. So we need to know how many bonds there are. So there's 300 bonds, and each of those bonds would be converted into 20 shares of stock. So 300 bonds times 20 shares is 6,000 shares. And each of those shares have a par value of $5. So when we get ready to convert, common stock will be increased by $30,000, or the 6,000 shares at its par value. So let's see how we convert. The first thing we know, we're going to debit bonds payable because the 300,000 in bonds is being turned in, and common stock is going to be offered instead. The second thing we have to do is, if there's any discount or premium, we need to eliminate its proportionate share. So we're going to credit discount on bonds payable, and what we're retiring is 300,000 of the 400,000 in bonds, or 3/4 of them. The discount account has a balance of 20,000. So 3/4 of 20,000 is 15,000. Let me move this over. And I look at this and say, you know, this doesn't balance. And we cannot have a gain or a loss on conversion. So what we use instead is the account paid in capital in excess of par, or just paid in capital, or you'll hear me call it pink, for the difference. Because this represents what the investors were willing to contribute above and beyond the par value to own the stock. So the paid in capital plug is $255,000. So let's see if we've answered the questions. Is there a gain or a loss on the conversion? And if so, how much? We don't recognize the gain, but instead we put it in paid in capital for $255,000. Question 2, how many shares of common stock are issued in exchange for the bond? We said there were 6,000 additional shares that were issued. And number 3, in dollar amounts, how does this transaction affect total liabilities and total shareholders' equity of the company? Well, let's take a look. Bonds payable is a liability account. So that's a long-term liability. Paid in capital is a shareholders' equity account. Discount on bonds payable is a contra liability account. And common stock is a shareholders' equity account. So what appears to be happening here is long-term liabilities are going down in exchange for shareholders' equity going up. So what we're doing is exchanging debt for equity, for ownership. So here we have some investors that were holding debt where they would receive the principal and the interest payments, and they're turning in that debt and instead saying, I want to be owners of this company and own stock instead. Now remember that stock You can get your money back if you sell your stock, or if you hold your stock, you have to wait until the board of directors declares a dividend before you see any cash coming your way. So very, very different ways to have a stake in the company, whether it's a creditor stake or whether you're an investor.